The phrase Trump silver tariff sounds dramatic, but the real significance is not in the headline, it is in the mechanism. Executive orders do not change markets because of rhetoric, they change markets because of incentives, constraints, and unintended consequences. When a tariff is placed on a strategic industrial metal like silver, it does not simply alter prices at the border. It reshapes supply chains, shifts trade flows, distorts market signals, and forces every participant in the system to reassess assumptions they previously took for granted. That is why this topic deserves careful examination rather than emotional reaction. Not because it guarantees a specific outcome, but because it alters the structure in which outcomes emerge. Silver is not just another commodity. It occupies a unique position at the intersection of industrial necessity, monetary history, and geopolitical strategy. Any policy that interferes with its flow has ripple effects that extend far beyond the metal itself. To understand why a silver tariff could revolutionize everything, it is necessary to understand how silver actually moves through the global system, how pricing is discovered, and how political decisions interact with physical reality. Executive orders are instruments of speed. They are used when policymakers want to act faster than the legislative process allows. This does not automatically imply emergency, but it does imply priority. When trade policy is adjusted through executive action, it signals that the issue is considered strategically important. Historically, tariffs introduced under such circumstances are not designed solely to raise revenue. They are designed to influence behavior. Behavior of producers, importers, manufacturers, and in some cases, markets themselves. Silver's role in modern economies makes it especially sensitive to such interventions. Unlike gold, which is primarily monetary and held for reserve or investment purposes, silver is consumed. It is embedded in electronics, renewable energy systems, medical devices, water purification, defense technologies, and advanced manufacturing. Once used, much of that silver is not economically recoverable. This means the physical supply of silver available to markets is continuously eroded by industrial demand. That erosion is slow but persistent. At the same time, global silver production is constrained. Most silver is not mined as a primary product. It is produced as a byproduct of mining other metals such as copper, lead, and zinc. This means supply does not respond quickly to changes in silver prices or policy signals. You cannot simply turn on more silver production because demand rises or because a tariff changes economics. Supply responds on a multi-year timeline, if at all. When a tariff is applied to imported silver or silver-containing products, the immediate effect is not scarcity, it is distortion. Importers face higher costs. Manufacturers must decide whether to absorb those costs, pass them on, or seek alternative supply routes. None of these options is frictionless. Each introduces inefficiencies into a system that already operates with tight margins and just-in-time logistics. Trade distortions often produce counterintuitive outcomes. A tariff intended to protect domestic industry can end up increasing costs for downstream manufacturers, reducing competitiveness, and incentivizing relocation of production. In the case of silver, where domestic production in many countries is limited, tariffs can effectively tax industry rather than protect it. The United States, like many advanced economies, relies heavily on imported silver for industrial use. Domestic production exists, but it does not satisfy total demand, especially when accounting for high-tech applications. A tariff therefore acts as a cost multiplier across multiple sectors simultaneously. Electronics, solar energy, electric vehicles, medical equipment, and defense systems all feel the impact. This is where the revolution begins, not with price spikes on charts, but with altered incentives across supply chains. When costs rise unpredictably, companies seek stability. Stability may come from long-term contracts, alternative suppliers, substitution where possible, or stockpiling. Stockpiling increases physical demand. Physical demand tightens markets. Silver markets are not deep relative to global industrial demand. They function smoothly because flows are predictable. When predictability is disrupted, even slightly, the system becomes sensitive. Sensitivity means small changes can have large effects. Executive orders also carry signaling power. Markets interpret them as indicators of broader policy direction. A silver tariff signals a willingness to use trade policy as a tool in strategic competition. That signal influences expectations about future interventions. Expectations shape behavior today. When expectations shift, pricing mechanisms adapt. Futures markets, which dominate silver price discovery, are designed to manage risk under stable policy environments. When policy becomes volatile, futures markets struggle to reflect physical realities. This creates divergence between paper prices and physical availability. Paper silver represents claims. Physical silver represents metal. When tariffs increase uncertainty around supply chains, participants who need silver prefer metal over claims. This preference shift does not require panic. It requires prudence. Industrial users cannot hedge delivery risk with cash. They need material. As physical demand increases relative to paper supply, premiums rise. Premiums are not always visible in headline prices. They appear in delivery terms, contract conditions, and regional price differentials. These are the early signals of stress. Tariffs also influence global trade flows. If one country imposes a tariff, exporters seek alternative markets. Those markets may have different pricing structures, different regulations, and different settlement practices. This can redirect silver flows away from traditional hubs like London or New York toward regional markets. Fragmentation reduces liquidity and increases volatility. Silver pricing has historically depended on centralized hubs and benchmark pricing. Fragmentation undermines benchmark reliability. When benchmarks lose authority, price discovery weakens. Weak price discovery increases uncertainty. Uncertainty benefits those with physical inventory and disadvantages those dependent on rolling paper exposure. This is a structural advantage, not a speculative one. Another often overlooked effect of tariffs is inventory behavior. When trade barriers are introduced, companies reassess inventory strategies. Just-in-time models become riskier. Holding inventory becomes more attractive despite carrying costs. Increased inventory demand tightens supply. Silver inventories are not unlimited. Above-ground stocks exist, but much of that silver is already spoken for, held in investment products, industrial use, or long-term reserves. When inventory demand increases, the available float shrinks. Shrinking float increases sensitivity to shocks. Sensitivity does not require large events to produce noticeable effects. Minor disruptions can have outsized impacts. Executive orders also interact with regulatory frameworks. Trade policy does not exist in isolation. It intersects with environmental regulations, mining permits, labor laws, and international agreements. Each intersection introduces friction. In the context of silver, environmental regulation is particularly relevant. Mining expansion faces significant hurdles. Even if higher prices incentivize production, regulatory timelines delay response. This means supply cannot quickly offset policy-induced demand changes. Geopolitically, silver tariffs can be interpreted as part of broader strategic competition. Strategic competition often leads to retaliatory measures. Retaliation can target different sectors, but it increases overall uncertainty. Uncertainty encourages diversification away from vulnerable supply chains. Diversification often means regionalization. Regionalization reduces global efficiency. Reduced efficiency increases costs. Increased costs feed back into inflationary pressures. Silver is embedded in inflation dynamics not just as a store of value, but as an input cost. When silver costs rise, downstream prices rise. This links silver policy directly to consumer inflation, even if indirectly. Policymakers often underestimate these feedback loops. Trade measures are introduced to achieve specific goals, but complex systems respond in nonlinear ways. Nonlinearity is where revolutions occur. The monetary dimension cannot be ignored. Silver has a long history as money. While it no longer circulates as currency, its monetary characteristics persist. During periods of policy uncertainty, monetary assets gain relevance. Silver's dual nature amplifies its response. If trade policy increases industrial demand while monetary uncertainty increases investment demand, silver experiences pressure from both sides simultaneously. This convergence is rare. When it occurs, outcomes tend to surprise. Surprise does not necessarily mean immediate price explosions. It often means prolonged periods of tension followed by rapid adjustment. Markets adjust when pressure exceeds tolerance. Tolerance is shaped by leverage, inventory, and confidence. Futures markets operate with leverage. Inventory levels are finite. Confidence is fragile during policy transitions. Executive orders, by their nature, bypass prolonged debate. This accelerates implementation. Accelerated implementation reduces adjustment time. Reduced adjustment time increases stress. Stress reveals structural weaknesses. In silver markets, those weaknesses include reliance on paper pricing, concentration of inventory, and dependence on predictable trade flows. Another important consideration is substitution. Can silver be replaced? In some applications, limited substitution is possible, but often at reduced efficiency or higher cost. In many critical applications, substitution is not viable. This makes silver demand inelastic in key sectors. Inelastic demand combined with constrained supply is a classic setup for price tension. Price tension does not always manifest in headline prices immediately. It builds in the background. Historical precedents are instructive. When governments have intervened in commodity markets, the initial effects often differ from long-term outcomes. Short-term suppression or stability can give way to long-term volatility or revaluation. Silver has repeatedly experienced periods of policy interference, followed by reassertion of fundamentals. This pattern does not guarantee repetition, but it provides context. The age group that understands this best is not seeking excitement. It is seeking preservation, predictability, and resilience. That audience recognizes that revolutions in markets rarely look revolutionary at first. They look technical. They look boring. They look like rule changes. Tariffs are rule changes. They change who pays, who benefits, and who bears risk. Risk does not disappear. It moves. In this case, risk moves from government balance sheets to industrial balance sheets, from paper markets to physical markets, from predictable systems to adaptive ones. Adaptation is costly. Cost shows up in margins, prices, and volatility. Volatility attracts attention. Attention changes behavior. Behavioral shifts are where narratives change. Silver narratives have long oscillated between irrelevance and alarm. The truth is structural relevance. If a silver tariff is implemented, the most important question is not how high prices might go, but how market structure will change. Structure determines resilience. Resilience favors those who understand supply chains, inventory dynamics, and policy incentives. It disadvantages those who rely on static assumptions. Static assumptions are common in stable periods. Policy shifts disrupt stability. Executive orders are disruptive by design. They are used to change trajectories. The revolution implied by a silver tariff is therefore not ideological. It is mechanical. It changes the machine. Machines respond predictably to friction. Add friction, output changes. Silver's machine is global, interconnected, and finely balanced. Friction matters. As this policy unfolds or is debated, watching behavior matters more than watching rhetoric. Watch import patterns. Watch inventory reports. Watch premiums. Watch industrial commentary. These signals precede price. Price is the last thing to move. Structure moves first. Those who wait for confirmation often find confirmation arrives alongside reduced options. This is why understanding matters more than timing. Timing follows understanding. The revolution is not that silver becomes scarce overnight. It is that assumptions about smooth availability, efficient pricing, and frictionless trade are challenged. Challenged assumptions force reassessment. Reassessment changes positioning. Positioning changes markets. That is how executive orders revolutionize systems without ever mentioning prices. Silver has always been sensitive to policy because it sits between worlds: industrial and monetary, physical and financial, domestic and global. When policy intervenes at that intersection, outcomes are amplified. The coming period will likely involve adjustment rather than resolution. Adjustment is uncomfortable. It produces noise. Noise is not clarity. Clarity comes from structure. Structure tells us that silver's importance increases when systems become less predictable. Predictability is declining globally, not just in trade policy. Trade policy is one expression of a broader shift towards strategic control. Strategic control conflicts with global efficiency. Conflict produces tension. Tension seeks release. Release takes many forms. Understanding this process is the advantage. This is not about cheering or fearing tariffs. It is about recognizing what they change. They change incentives, they change flows, they change risk distribution, they change narratives. Silver responds to all of these. That is why this executive order, if enacted, does not simply tweak markets. It reshapes them. Revolutions in finance are rarely loud. They are procedural. By the time outcomes are obvious, the process is complete. Those who study the process do not need to rush, they prepare. Preparation is the quiet response to structural change. Silver has waded through many such cycles. It remains. Understanding why is the purpose of this discussion. What makes trade policy involving silver especially powerful is that it operates at the intersection of visibility and necessity. Silver is visible enough to be regulated and tracked, yet necessary enough that demand cannot simply disappear. This combination creates pressure that does not resolve through avoidance, but through adjustment. Adjustment is where unintended consequences accumulate. When policymakers design tariffs, they often focus on first-order effects such as domestic protection or leverage in negotiations. Markets, however, respond in layers. The second and third layers are where revolutions quietly form. One of the first second-order effects of a silver tariff is the revaluation of domestic versus foreign supply chains. Manufacturers must decide whether to absorb higher input costs, redesign products to use less silver, or relocate production to jurisdictions where silver flows are unrestricted. None of these choices is neutral. Absorbing costs reduces margins. Redesigning products often reduces performance or reliability. Relocation increases geopolitical and operational risk. Each choice introduces friction into systems that previously relied on efficiency. Efficiency has been the defining feature of globalization. Silver flows freely across borders because it has to. Modern technology depends on it. When efficiency is compromised, inventories become strategic assets rather than logistical necessities. Companies begin to think less about minimizing storage costs and more about ensuring continuity. Continuity requires stockpiles. Stockpiles reduce available supply. Reduced supply increases sensitivity. Sensitivity is not volatility in price alone. It is volatility in access. Access volatility is far more disruptive than price volatility. Prices can be hedged. Access cannot. If silver is unavailable at the moment it is needed, production halts regardless of price. This reality shifts bargaining power away from financial markets and toward physical holders. This shift is subtle but profound. For decades, price discovery in silver has been dominated by futures markets that prioritize liquidity and leverage. These markets function optimally when physical delivery is rare. When delivery becomes important, futures markets must adapt or lose relevance. Adaptation often involves cash settlement incentives, rule changes, or margin adjustments. Each adaptation distances price further from physical reality. A tariff accelerates this process by injecting uncertainty into physical flows. Uncertainty encourages precautionary behavior. Precautionary behavior increases physical demand independent of price signals. This decoupling is how paper markets lose authority without dramatic events. Another underappreciated consequence is the impact on recycling. Silver recycling is often cited as a buffer against supply constraints. In reality, recycling responds slowly and inconsistently. It depends on collection infrastructure, price incentives, and technological feasibility. Tariffs complicate recycling economics by altering cross-border movement of scrap and refined material. This can reduce effective recycling supply even when prices rise. As recycling becomes less responsive, primary supply constraints become more binding. This further tightens the system. Tight systems behave differently than loose ones. They transmit shocks rather than absorb them. The geopolitical dimension deepens these effects. Trade policy rarely exists in isolation. It interacts with alliances, rivalries, and strategic competition. If one country imposes tariffs on silver, others may respond by prioritizing domestic needs or redirecting exports. Export controls, even informal ones, amplify scarcity perceptions. Perception alone can change behavior. Silver's role in defense and critical infrastructure makes it particularly sensitive to national security considerations. Governments are increasingly classifying materials as strategic rather than purely commercial. Strategic classification often leads to stockpiling, export scrutiny, and preferential allocation. These measures reduce market availability without reducing total supply. The effect is similar to scarcity. When markets perceive scarcity, behavior changes quickly. Not because people panic, but because they reassign probabilities. Probabilities of delay, disruption, or restriction increase. Rational actors respond by securing supply earlier and for longer durations. Long-term contracts increase. Spot availability decreases. This is how gradual policy changes produce nonlinear market outcomes. Nothing dramatic needs to happen. Systems simply become tighter until they reach thresholds. Thresholds are where revolutions occur, not ideological revolutions, but mechanical ones. Systems flip from one mode of operation to another. In silver markets, the flip is from abundance-based pricing to scarcity-aware pricing. Scarcity-aware pricing is fundamentally different. It reflects access risk, not just value. The age group that understands this has seen it before in other commodities. Energy markets provide a useful parallel. When energy flows are disrupted by policy or geopolitics, prices do not immediately reflect physical shortages. Inventories cushion the impact. But as inventories draw down and replacement becomes uncertain, pricing regimes change. Volatility increases. Contracts become more complex. Political involvement intensifies. Silver is following a similar path, but with unique characteristics. Unlike energy, silver is embedded in both monetary psychology and industrial necessity. This dual role amplifies responses. Another critical layer involves currency dynamics. Tariffs are paid in currency. If silver tariffs raise costs for domestic manufacturers, those costs interact with inflation dynamics. Higher production costs contribute to inflationary pressure. Inflation pressure influences monetary policy. Monetary policy influences currency strength. Currency strength influences silver demand as a monetary hedge. These feedback loops reinforce one another. If monetary authorities respond to inflation by tightening, borrowing costs rise. Higher borrowing costs slow investment and growth. Slower growth increases political pressure. Political pressure often leads to further intervention. Intervention feeds uncertainty. Uncertainty feeds demand for tangible assets. Silver sits at the center of this loop. It is both affected by and reactive to each stage. That is why small policy changes can have outsized effects over time. Trade tariffs also influence reporting and accounting behavior. Companies may reclassify inventory, alter hedging strategies, or change disclosure practices to manage perceived risk. These changes affect market transparency. Reduced transparency increases uncertainty. Increased uncertainty reduces confidence in benchmarks. Benchmarks are essential for functioning markets. When confidence in benchmarks erodes, participants rely more on bilateral agreements and physical verification. This reduces liquidity. Reduced liquidity increases volatility. Volatility attracts regulatory attention. Regulatory attention often leads to further rule changes. Rule changes alter incentives again. This cycle continues. What distinguishes revolutionary periods from normal volatility is persistence. If policy-induced distortions persist, markets cannot revert to previous equilibria. They must find new ones. New equilibria involve different participants, different pricing mechanisms, and different power structures. In silver markets, this could mean increased importance of regional hubs, long-term offtake agreements, and strategic stockpiles. It could mean reduced influence of leveraged trading and increased influence of industrial buyers. It could mean greater divergence between quoted prices and actual transaction prices. These changes do not require conspiracy. They require incentives. Incentives are created by policy. Executive orders are blunt instruments. They do not fine-tune systems. They push them. Systems respond by bending or breaking. Silver's system is flexible, but not infinitely so. The revolution, therefore, is not about a single tariff. It is about the precedent it sets. Once silver is treated as a strategic trade lever, it will be viewed through that lens in future decisions. That lens prioritizes control and resilience over efficiency and cost minimization. Control-oriented systems behave differently. They favor redundancy. Redundancy increases costs. Costs influence prices. Prices influence narratives. Narratives around silver will shift accordingly, from cheap industrial input to strategic material, from speculative asset to essential component, from ignored metal to managed resource. Management implies oversight. Oversight implies intervention. Intervention implies distortion. Distortion is not inherently negative, but it is transformative. It changes how markets function. For long-term observers, the key is not to predict precise outcomes, but to recognize direction. Direction appears to be moving toward increased strategic control of critical materials. Silver qualifies as critical by virtue of its industrial role and monetary history. When direction is clear, preparation is possible. Preparation involves understanding where bottlenecks may form, how access might change, and which assumptions are most vulnerable. One vulnerable assumption is that silver will always be available at quoted prices. Another is that paper exposure is equivalent to physical access. A third is that policy changes will be temporary. History suggests that once strategic control frameworks are established, they tend to persist and expand rather than retract. Retraction occurs only when costs outweigh benefits. That can take years. During those years, markets adapt. Adaptation creates winners and losers. Winners are not necessarily those who predict prices correctly. They are those who structure exposure intelligently. Structure matters more than speculation in transitional periods. How silver is held, sourced, and contracted matters more than where it is priced on any given day. This is why the discussion around tariffs should not focus exclusively on bullish or bearish outcomes. It should focus on system evolution. System evolution determines opportunity and risk. Opportunity emerges where friction creates value for those who can manage it. Risk emerges where assumptions fail. The older, more experienced audience understands this instinctively. They have lived through periods where policy changes reshaped markets quietly and permanently. They recognize that revolutions in finance often look like administrative updates until their consequences accumulate. Accumulation is slow, then it is fast. Silver's accumulation phase is occurring across multiple dimensions simultaneously: industrial demand, monetary uncertainty, trade policy, geopolitical competition, regulatory oversight. None of these alone is decisive. Together, they are transformative. This convergence is what makes the current moment unique. Not dramatic, but decisive. Those looking for confirmation will likely miss the process. Confirmation arrives after adjustment. Adjustment is when options narrow. Those who focus on understanding can maintain flexibility. Flexibility is the ultimate advantage in uncertain systems. Silver offers flexibility when held and structured appropriately. That appropriateness is context dependent. Context is changing. Executive orders accelerate context change. They compress timelines. They force decisions earlier than markets expect. Early decisions shape outcomes. Late decisions accept them. This is why understanding executive actions matters even before they fully materialize. The anticipation itself changes behavior. Anticipation is powerful. It shapes markets ahead of reality. As anticipation builds, markets reposition. Repositioning creates flows. Flows reveal priorities. Watching flows is more informative than watching headlines. Flows show where capital, material, and attention are moving. In silver markets, flows are beginning to reflect caution and preparation rather than complacency. That does not mean crisis is imminent. It means equilibrium is shifting. Shifting equilibria are uncomfortable. They generate noise. Noise can be mistaken for danger. It can also be ignored as background. The correct response is neither fear nor dismissal. It is analysis. Analysis reveals structure. Structure reveals incentives. Incentives reveal direction. Direction matters more than speed. Speed will vary. Direction is durable. The revolution implied by a silver tariff is therefore a revolution of incentives. Incentives reshape behavior. Behavior reshapes markets. Silver is sensitive to this process because it cannot be abstracted away from reality. It is physical. It is consumed. It is essential. When policy touches such assets, consequences ripple. Understanding those ripples is the purpose of this discussion. Not to alarm, but to inform. Not to predict, but to prepare. Preparation does not require action today. It requires clarity. Clarity is built by studying mechanisms rather than headlines. Mechanisms do not lie. They only respond. Silver will respond as it always has, by reflecting the balance between control and necessity. That balance is shifting. Recognizing that shift early is the advantage. Silver has waded through many such cycles. It remains. Understanding why is the purpose of this discussion.